From Embark's headquarters in Dallas, Texas, this is Accounting Matters, an accounting podcast powered by Embark. Hi, hello, good afternoon. It's great to be with each of you. I'm Zac Smith, Embark's Tampa Market President, and I'm joined with my co-host, Adam Olsen, Embark's Accounting Advisory Practice Leader. On this week's episode, we're going to continue our previous discussion on profit interest with the one and only Nicole Harger, a Senior Director in Embark's National Quality Group. Both of you, thanks for joining.
Glad to be back.
Yeah, thanks for having me again.
Yeah, absolutely. I'm so glad you guys could make it back. How's your summer going?
Good. It's hot.
It is hot.
It's very hot in Dallas.
Hot in Dallas,
which
indeed.
Should not be a surprise, I guess, but, you know, it'd be nicer.
Yeah, absolutely. Well, hopefully we're wrapping up soon with it. Last time we connected, we discussed what profit interests were, why they are often used as a form of compensation, and how the accounting guidance applies to each of these awards, even though it's not necessarily always clear. I encourage our listeners, if you haven't tuned in to that episode, take a listen today. We're picking up on part 2 of this topic and getting into some of the accounting and reporting differences that exist. Can you guys recap what guidance profit interest awards could fall under?
Yeah, obviously a big cliffhanger from last week, but for those of you that maybe didn't have a chance to or forgot to listen or forgot what we said, just to recap real quickly. So, you know, a big part of the conversation we had in our first part was around having to evaluate really kind of the substance of these awards. So looking at the different terms, conditions, features, you know, the merits of the awards themselves, because there is a lot of judgment that has to be applied. So there's a bunch of indicators that have been developed in practice that are used commonly to help decide whether or not an award should be accounted for under ASC 718, kind of in the stock compensation guidance, or in other compensation guidance in ASC 710. I will say we've also done previous podcasts on accounting for stock-based compensation awards. So if you end up with an award that does fall under 718, you know, we'll touch lightly on some of the differences today between 718 and 710. You know, which is why it's so important that you know you understand which bucket you fall into, because you'll see why there's so many differences in the accounting. But to get more insight on accounting for awards under 718, you'll take a listen to some of those previous podcasts, because we go into much more detail than we'll do today.
Yeah, okay, great. But let's talk a little bit about each of those.
Sure.
I think it might be helpful to do a little bit of compare and contrast between the two to help illustrate the accounting varieties and why the initial evaluation is important to not shortcut. Can you share a little bit about that?
Yeah, let's, so we can, you know, just kind of talk through the different, you know, concepts that you would go through in any accounting guidance. So, you know, let's take classification first. Like, you know, how would these awards be classified on your balance sheet, you know, if you had a 718 award versus a 710? So we'll start with the easy one. So 710 awards, it's pretty straightforward. They're always going to be recorded as a liability on your balance sheet. If you determine your award falls under the 718 guidance, your award can be classified as either equity or a liability. So to determine that, you would look to the classification guidance that does exist within ASC 718 to figure out, hey, do I have any characteristics in my award that would require it to be classified as a liability? If not, then the award would be classified as equity. So not to rehash some of that, because there is some complexity in that assessment. So again, just kind of plug our stock comp podcast for the second time in 2 minutes. But just some common conditions that will throw an award as being a liability classified award under 718 would be, you know, if the award's indexed to something other than the common vesting conditions, so a market performance or service condition, if the award meets any of the criteria under ASC 480, any of that guidance. Lots of times awards that have repurchase features that, you know, allow the holder to avoid kind of the risks and rewards of a typical equity ownership. Those could fall under liability guidance. So just to name a few of them, you know, throw those out there. But like I said, definitely look at that guidance. It's pretty explicit in 718. So at least there's a little less judgment to apply there, but still some.
Yeah, and I know that we discussed classification in much more detail in the 718 podcast. So again, check that out if you want to hear more about awards that may have terms or conditions that could require liability classifications. But so after classification is squared away, I think a lot of preparers would be asking how you measure the award on the balance sheet. How does that work between the two sets of guidance? Are there any differences? Are there any similarities? What do we need to be thinking about?
Yeah, so for measurement of the award, so if you got a 718 award, you're going to measure the award at what's called its grant date fair value. So that's going to be the same for whether it's an equity classified or liability classified award under 718. For equity classified awards, I will say that once you determine that grant date fair value, you don't remeasure those awards unless there's a modification, subsequently or down the road. For liability classified awards under 718, though, each reporting period you would subsequently remeasure that. So you're essentially establishing a new, what would be considered a settlement date fair value until you actually settle that award. 710 awards are a little bit different. So they're measured like performance bonuses, which are basically measured kind of at the present value of kind of the future payments that will be made under that award. So similar to what we had for liability classified awards under 718, under 710, you would also remeasure those awards every reporting period until it's settled, but it's a little bit different. You've got grant date fair value under 718 and the present value of kind of future award payments under 710.
So then, Adam, is it fair to assume that the profit interest awards have no value at the grant date in certain cases for the awards that are accounted for under the 718 guidance? And then part two, let's just say that given these distribution thresholds or hurdles, nothing would currently be paid out for the award if we walked through the waterfall.
Yeah, no, that's a good question. We get that. We get clients that always argue this point a lot of times. They're like, well, yes, we've granted these awards, but, and we'll say, well, how are we going to measure or value the awards? And like, well, there's no value because, they've got this threshold or this hurdle. And when we granted the award, like that wasn't going to be met. Like if we liquidated our company immediately today on the grant date, they would get nothing. And we talked about during our part one, another argument they often make is like, well, from a tax basis perspective, the awards have zero value. So we think there should be zero value assigned to these awards at the grant date. Unfortunately, that's not the correct way to think about it. And I say that because, making the argument that these profit interests have no value really kind of negates the fair value measurement guidance in GAAP. And also to assume like, hey, if we liquidated our company today, profit interest holders would get nothing, also contradicts the concept that your entity is a going concern and you report your financials on a going concern basis. So you can't really say, based on liquidation, this is what the award's worth today. That doesn't carry as much merit either. So you definitely have to think through like what value should be assigned, particularly for those 718 type awards.
Okay, so then how often are these awards valued?
Yeah, so not going into a ton of detail here. Like obviously this is where you would want to engage a valuation specialist to assist. But typically what happens...
Is this valuation work that Embark does?
We do valuation work, and we do a lot of valuations of profit interest for sure. And our valuation specialists here at Embark as well will tell you that they also get we think there's no value assigned to these awards, and they probably more eloquently explain why that is not true. But generally what a valuation specialist will do a lot of times with these awards is because these profit interests, they have these different waterfalls, and they're all going to vary depending on the equity structure of the entity that grants the awards. They might consider a bunch of different, reasonable cash flow outcomes that could exist, and looking at those holistically or averaging them or coming up with some type of statistical answer with some complex valuation approach. They'll figure out what is a reasonable barometer for the value of the awards themselves. So like I said, it's not usually something that a lot of these awards can be a little complex with the terms and conditions and stuff like that. So it does require usually bringing in an evaluation specialist, but that's also probably the reason why a lot of clients want to just kind of jump to a $0 answer, because
Of course. One less step that they have to do.
it's quicker, it's easier, they don't have to record anything, but
Yeah.
a lot of times that you should get pushback from your auditors, typically for a 718 type award.
Okay. Well, so Nicole, I'm going to turn to you on this one. So we know the amount that we measure the award at, but how does an entity determine when to recognize the reward in the financial statements?
Yep. Recognition can be a little trickier, so we're going to look at each model a little bit closer. So under ASC 718, the award is recognized as compensation expense over the employee's service period using either a straight line method or for certain awards that have multiple tranches under a graded vesting method. So a graded vesting method just basically front loads the recognition of compensation expense compared to the straight line method as each separately vested tranche is recognized as though each one is a separate award. And then under ASC 710, compensation expense and a liability isn't recorded until payment is probable and reasonably estimable. So sometimes we get questions about what it means for a payment to be probable, and the accounting guidance defines that as that future events are likely to occur. So keep in mind, in the accounting world, there's no bright line to apply here, but generally in practice, a lot of preparers consider probable as having a 70% chance or greater likelihood of an event occurring. So as it relates to the second criteria, most profit interest awards are reasonably estimable at the grant date.
Okay, so that makes sense. And I know a lot of profit interest awards have performance conditions, whether it's an EBITDA target to achieve or an exit event. 718 is pretty clear on these conditions and how they're accounted for. But for an award that we determine should be accounted for under 710 that has a performance condition, what specifically happens here in this situation?
Yeah, that's a great question. And you're right. Performance conditions are included in a lot of profit interest awards that we see. In these cases, compensation expense should be recognized again when it is probable that the performance condition will be satisfied, like we talked about previously. The challenge comes in when at the grant date it's not probable that the performance condition will be met. So at the grant date, no compensation expense is recorded, but then subsequently that changes. How does one account for that change in the assessment of performance conditions? So in practice, there are two common approaches used. You can either do a catch-up approach or a prospective approach.
Okay, and so then can you give us an example of a scenario where we would have a performance condition that is subsequently probable of being met and illustrate how those two approaches would be used? I think that's going to be, it sounds like more typical in how that is played out.
Yeah, so let's say a profits interest award has a performance condition where the underlying shares vest when cumulative income over, let's say, like a 5-year period reaches a certain dollar amount. If on the grant date, the entity concludes that it's not probable that the performance condition will be met, no liability is recorded, and no expenses incurred for the performance condition. However, let's say like at the next reporting period or subsequent reporting periods down the road, the company does conclude that it is probable that the performance condition will be met. They have two options that we just mentioned. So under the first option, the reporting entity can increase the accrual to reflect the amount that cumulatively would have been accrued by the end of the reporting period had the performance condition been assessed as probable, so like from the date of inception of service. Then the remaining balance thereafter is accrued as future services are performed. The second approach would be for the entity to account for the increased compensation prospectively, so they would just accrue the total amount of estimated compensation assessed as probable over the remaining service period. So either method again is acceptable and should be viewed as an accounting policy election and then disclosed in your financial statements.
Okay, so that's helpful and that makes sense, but what happens in the reverse scenario? So let's say a performance condition was probable initially, but later down the road it looks like it's no longer probable of being met. What happens here? What do we need to think about?
Yeah, so going back to that previous example, if it's determined that the 5-year cumulative income condition is no longer probable, any previously recognized expense would be reversed in the period in which the change in probability occurred.
Okay. And so then in our first episode on profit interest, we talked about the ability of the award holder to receive distributions. If a distribution is made, how does that impact the total compensation cost that you recognize for this award?
So generally it doesn't.
Okay.
Distributions to ASC 718 award holders are treated as dividends, and they do not result in any additional compensation costs unless a modification or reclassification or settlement has occurred. Distributions to award holders that are accounted for under 710 are not dividends. It's just treated as additional compensation cost.
Okay, and so now that we've covered the recognition side, Adam, measurement and classification of profit interest awards under both 710 and 718, is there anything that our listeners need to be aware of from the reporting and presentation perspective?
Yeah, there's, one thing we see come up a lot is when like a parent company of a subsidiary will, issue equity awards to an employee of that subsidiary. And there's often a question about where does the compensation expense get recorded because it's a parent's equity instrument that's issued to an employee of a subsidiary. And so just to be clear on how you should think through something like that is, the substance of that transaction is basically that the parent is making a capital contribution of those awards or those interests to the subsidiary, and then the subsidiary is granting that to the employee. So the compensation expense should be recorded at the subsidiary's level, especially if they're issuing their own standalone financial statements, because it's in exchange for services for those employees at that subsidiary level. And that would be the same whether you're accounting for it under 718 or 710.
Okay, well, that's really helpful. And before we wrap up, given the subjectivity around how to account for each of these awards, I can imagine that there can be some diversity in practice. So is that a concern to the FASB? What are they doing about that? And how do our clients and folks need to be thinking about it?
Yeah, that's a great question. I know we kind of teased this out a little bit in part one of this conversation, but it is something that is currently being looked at. And so we mentioned that a lot of profit interest awards are issued by non-public companies, so non-public partnerships and non-public LLCs. So the Private Company Council, or PCC, which is essentially like a subset group of the FASB that really focuses on accounting and reporting issues and matters that are relevant to private companies. They actually took up a project back in 2020 on this matter, so really looking at profit interest and the accounting for profit interest. And that was after they put out a request for consultation on their agenda, like what would people like to have them focus on and look into. And so profit interest was raised as an item, and they've been looking at it, like I said, for the last couple of years.
Okay, and so what's the latest update on the project, and where does this stand?
Yeah, so it's definitely been moving along. They did a lot of research, a lot of outreach, really looking at what are some of the nuances. Had some respondents provide some conceptual ideas for how they could think about alternatives to the accounting. So the most recent update was back in April of 22 is when they last met and discussed this. So in that meeting, the PCC actually proposed that they would add a project to their technical agenda that would essentially address how profit interest awards should be accounted for and whether they should only be accounted for under ASC 718. So obviously, as they kind of move forward with that potential project and, potentially issuing something specific for private companies, it would essentially eliminate a lot of the complexity that we've talked about, in part 1 and part 2, about having to decide 718, 710, looking at all these indicators. It would almost just create like, hey, these awards are never in the scope of 710. They're always going to be viewed as stock compensation, so you should follow that guidance. So the PCC also recommended to the FASB that they should add a project to their own technical agenda that would also address kind of the appropriate scope of the guidance for profit interest awards as well. And similar to what we've discussed, they note that there's also a lot of diversity in practice, and again, the complexity and kind of having to navigate the guidance there with the lack of actual authoritative guidance that exists. And also just highlighting to the FASB that it may be prudent for them to do so because, this issue can affect not only private companies, but also public business entities. So, we'll kind of have to see whether the FASB takes it up on a larger scale and whether they do anything with it. But at least for the time being, it is a project that the PCC is adding to their agenda, and they'll start, kind of moving through the process of potentially drafting some guidance on it.
Well, great. Well, I know we're all sitting on the edge of our seats waiting to hear what they have to say. Maybe you guys will be out of a job soon and no longer needed to review these things. But with all sincerity, thank you so much for both of you spending the afternoon with us, talking through some of the complexities and the accounting nuances for profit interest. I know that this has been helpful not only to myself, hopefully to our listeners and to our viewers. So until next time, I appreciate it.
You bet.
Yeah.